You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is the program for busy financial advisors as well as their clients, where we explain to you how you too can incorporate all the benefits of options into your portfolios. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs for you guys to choose from on said network, including many, many archived episodes of this fine program. And where can you find them all? Well, of course, the mothership, theoptionsinsider.com. That's where all of the content originates from. You can find all of the archived episodes of this program, as well as every other episode of every other program we've ever done in our almost 8-year history now on the old Options Insider Radio Network up there for your listening pleasure, your perusal. You got a few hours, you're traveling, you're commuting, you want to listen to some archived episodes. We certainly got them for you. You can also find them iTunes, Stitcher, Aha Mobile, wherever you like to find your finer podcast programs. And, of course, we baked them all into one cool mobile app available for iOS, Android, and even the Fire OS. I'm sure a few of you got a few Fire phones over the Black Friday holiday. So no shortage of ways for you guys to get in touch with and enjoy and interact with our content here on the old Options Insider Radio Network. And joining me on the Advisor's Option program today, starting off, he gets the points for beaming in from the farthest distance away from our HQ here in Chicago, none other than Mr. Randy Swan. He is the co-founder of Swan Wealth Advisors, enjoying the almost tropical weather out there in Puerto Rico these days. Welcome to the show, Randy.
Thanks. It's great being here. Looking forward to another awesome edition of the Option Show.
Yeah, it should be pretty fun. And also joining us, beaming in from not quite as far away, but also not from his usual stomping grounds up north, up there in the Nutmeg State. No, he's down there in the Sunshine State these days. Mr. Eric Kott, the Director of Financial Advisor Education over there at the Options Industry Council. Eric, welcome back to the program. It has been too long.
Mark, great to be back with you, Randy, and Michael, my colleague, unfortunately is unable to make it. He's busy preaching the gospel on the streets of Chicago. And yes, I have left the wonderful Nutmeg State to head down to Florida and be with all of the retirees who, Mark, you should know this, doing the show for 8 years, which, by the way, congratulations, is amazing. This is the hotbed of retail options. Everybody down here wants to know the secret sauce, and obviously we'll be delivering it today on your show.
The hotbed for income and risk management. Scenic and sunny Florida. Lots of conferences down there, Boca, all that whole area. Everyone wants to know the latest tips and tricks. So you're right. Maybe we should do a live show from Florida down there one of these days. And joining me last but not least on the old panel today, beaming in from right down the street here from the old Options Insider studios here, Mr. Mike Cavanaugh, a principal over there at RCM. Mr. Mike, welcome back to the program. Sir, it has been far too long.
It has. It's. Did I hear you say we're doing a live show in Florida?
We should.
I'm in.
I don't know if you know this, but it's on RCM's tab, so you guys are handling all that.
Hey, we'll put it on the Futures group.
There we go. I like
Bobby's going to bring his plane down here for everybody to fly you guys.
There you go.
Steak dinners, corporate jet, the whole 9 yards. Should be a good event.
Yeah, we'll be in Miami next week. I'll mention more of that at the end of the show.
There we go. All right. With the panel all assembled, listeners, it's time to dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. That sad trombone there means it is time once again for the Options 101 segment. As the name implies, this is the portion of the program where we break down an interesting, basic, or sometimes a little bit more advanced option strategy and tell you how you can incorporate that into your own portfolio or those portfolios of your clients. And today we were talking about what should we hit on today, what hasn't been discussed in the myriad archived episodes of this program. We've hit on different aspects of things like collars and straddles and things like that. And we talked a lot about collars and how attractive those are. Then we thought about what if we tweak it a little bit, tweak that collar idea. And so the idea of the covered strangle, also known sometimes as the covered combo, no, not a big fan of that name, but it's an interesting strategy and it combines a lot of what we're talking about here in the past, particularly for you covered call traders out there. It's an interesting idea. And it's a pretty basic concept, really. If you're familiar with a covered call, you can wrap your heads around this concept as well. So basic covered call, of course, involves owning a long underlying position, usually in an equity. Now, let's say we're trading everyone's favorite, XYZ. I've made and lost fortunes. I'm sure you all have as well in XYZ over the years. Let's say XYZ is trading at $50, and you're looking around, you're saying, I'm happy if the underlying gets to 55. I'm happy selling it away at that 55 level. So I'm going to write that 1 month 55 call. Let's say I get $1 for it. So now I'm getting 2% for a 1 month call that I've written. It's a pretty standard procedure. You guys are certainly familiar with that. If you're not familiar with covered calls, go check out the archives of this program. We've discussed that topic and that strategy extensively here on the show. But some people might say, I want a little more. I want to do a little bit better than 2% on this equity position I have here. And looking at the fundamentals, doing my own research, I've decided if this underlying in this scenario gets down to 45, I like it. I want to buy some more. That's a key point to wrap your head around in the covered strangle. If you don't have that outlook, you don't want to do this strategy. So now you say to yourself, well, at 45, I don't mind writing a put there and perhaps collecting a little bit of additional income. So let's say in this scenario, for the purposes of our example, you collect another $1 for selling that put at the 45 strike. So now you collected $1 for the call, $1 for the put, $2. Now you've got a whopping 4%. So you've doubled your income essentially by doing this strategy. Now, if you listen to our earlier programs, when you write a put, what does that mean? You essentially agree to buy that stock at that strike price. So now you have a very, very clear window over the next month where if the underlying rallies to 55, You'll be a very happy camper because you're getting out of 55 plus the $2 you just collected to sell those options, so 57 effectively. And if it gets down to the downside, you wrote it at that 45 strike, but you collected $2 to do that on the call and the put. So you're actually getting in at an effective price of 43, which will make you very happy. So either way, unless the underlying takes a really, really aggressive downturn in the near term, it's a pretty attractive strategy, and you could see why. And it's a pretty popular one, yet for a number of reasons, it doesn't really get a lot of the interest, a lot of the love, a lot of the traction in the advisor and retail space that it perhaps should, given the viability of it. Maybe, Mike, we'll start with you. I know you guys do a lot of different strategies on behalf of your clients and talking to a lot of other advisors over there at RCM. You talk to them through a lot of different strategies. What's your take on something like this, the covered combo, and what suitability it has for different people using different environments and different portfolios?
Yeah, no, I like the strategy. We don't implement this strategy for anyone. I like it. I think it's suitable for those that understand the risks. So if you have your advisor go over the different, where you make money, how you could potentially lose money on a strategy like this, I think it's a great, especially in this low yield environment we're in, when the market's been going up like it has, this is a great way to complement the yield in a portfolio. As long as you understand the risk involved, I mean, you're basically just adding a combo, a little bit more risk by selling that put. But if you take half of the stock position, or if you understand what those risks are and you're comfortable with those risks, I mean, and you're a long-term investor, I think this is a great complement to a low yield environment that we're seeing right now in the U.S. equity markets.
You guys do something a little bit analogous to this now. It's I guess you can almost think of it as a time-covered strangle, because you do that wheel trade you guys love so much. You sell the put first, then you wait to get a sign, then you get the stock, and then you wait to write the call after it. So it's kind of like you're doing the individual legs of the covered combo or the covered strangle, just not all at the same time.
This is kind of like, this would be like a larger wheel of fun. This is the big boy wheel of fun. the covered strangle. Yeah, we have the put that we sell, and if it expires worthless, it expires worthless. Worthless. If we get a sign, then we come in and we sell the call. This gives you the added value of you're long the stock. You're getting the dividend from the stock if it does pay a dividend, and then you're selling the call, and then you've got the enhanced portion by selling the put. So as long as you're comfortable and you understand that selling a put while you're long the underlying, you're adding to your potential risk. I mean, which the upside is you're adding to your potential reward as well. So as long as you understand the outcomes, and like if anybody ever wants to understand what the outcomes are, I mean, really all you need is a sheet of paper. And ask yourself, what happens if it goes to, if the stock goes to this price? What happened if the stock stays put? What happened if the stock goes to this price on the upside? So as long as you look at what could happen, and you understand what the risks are, I think this is a great, like I said earlier, I think this is a great strategy to enhance the income in a portfolio, especially in this low yield environment. It's like the zombie bank era in Japan here. There's been no interest rates in the stock market since 2008. So we're on 6 years of a very low yield environment, and this can help add to the yield.
What I might add to Mike's point there, which I think is quite indicative of what advisors are doing. Not all firms, Mark, as you, Randy, and Michael and I know, not all firms allow sort of multi-leg trading, which they look at. Unfortunately, compliance looks at it that way. I also agree with Michael. I think that it's a very appropriate strategy. What we've seen out in the field, and I think I see it more from the pension fund side, Mark, is large pension up in Canada, another one in the state of New Jersey. They have initiatives that their policy statements institute for them. And, they need to be in the marketplace. And this is kind of a great strategy for them, to sell that call, but also, do the cash secured put. So in this covered combo strategy, I've seen there's another pension in California, an endowment with the university that I've talked to over the last 4 months that utilizes this strategy quite often. I would like to see more advisors do it. I think that, this is a way to stay proactive with a client where, you like a stock and, you're buying, as Michael said, you're buying a portion of it. but you might be concerned that the thing is going to drop lower, but you want to own it. So, it's one of these proactive strategies that once the client gets the understanding of it, I believe that more advisors would implement this.
And Randy, I'd imagine you're probably a big fan of this strategy. You're implementing something analogous to this now, but a little bit different. You certainly have that covered strangle portion in place of your overlay, but you also have really that long put above it. So you're really more of a put spread to the downside and the covered call to the upside as opposed to the naked put. But I'd imagine you can see the value of a strategy like this for a lot of advisors out there.
I think it's a great strategy, especially in a flat to rising market. It's obviously not so great in a year like 2008 where the market's selling off substantially, but as long as you know the risk of potentially doubling down on your position, I think it's a great strategy, and I think it's probably worked very well this year.
Yeah, this certainly hasn't been a bad environment for it. You have the upside, you're capping a little bit with the covered call, but as long as you're okay with that and you understand that impact on the strategy, then certainly it is a decent environment for that. Before I move on from the covered combo, I keep saying covered combos. Someone else mentioned that strategy name to me recently. I hate that term. Really, it's a covered strangle. But someone put that term in my head, and now it's sticking. But Eric, this might actually predate you at the OIC a little bit, but wasn't there some early research back when you guys were first and Phil was there and you guys were first doing the collar strategies and getting a lot of feedback, a lot of interest in that? Wasn't there some talk in doing perhaps a study on this as well, a covered strangle study, and then it just blew too many advisors' minds to have those two short legs, so he ended up not doing it? Am I remembering that correctly?
You are. Interesting you should mention that, Mark, because this is a great opportunity for me to say that we are working on a study right now with Notre Dame, which is going to use this strategy that you love to talk about, your covered triangle. I'll remove the C-squared term from my vocabulary. I'll only use the covered triangle term as we go forward. But we are actually incorporating that along with 4 other strategies, and my hope is that the early part of 2015, the OIC will be releasing this study, which is actually going to be using 10 of the most frequently held names in DC plans. As per a large business media company who I won't mention, it's not Options Insider, but it's probably a little bit bigger than them, and they are on cable TV. But let's just say that they came out with a couple of years ago with the 10 largest names in DC plans. We took that information, and now we're going to incorporate in a research study 5 different overlay strategies, one of them being the covered triangle in there. So I think we'll have some interesting data. And Mark, obviously, you'll be one of the first to get a hold of this, and we'll talk to you about that. But yes, you're correct. We did look at this, but unfortunately we focused, not unfortunately, I think at the timing, back in 06 and 07, we focused on the buy right and the collar. And now we were able to, within the last 12 months, take 5 different strategies, but utilize for the first time ever real names, not the widget XYZ companies.
That's heresy, sir. There is no media company bigger than the Options Insider Media Group, so I'm not sure what you're speaking of. Clearly, your perspective is warped and twisted. But, that actually is interesting timing. I didn't know that. I didn't know that you guys are actually working on a study like this. So opportune timing for all of us. I'm looking forward to seeing the results of that. I know the collar strategy and the collar study really surprised a lot of people. I'd be curious to see the response to this as well, because I'd imagine once people get over that initial maybe reluctance they have to it or initial fear they have of having that extra short leg out there, then I think they'll be surprised at what this kind of strategy can do for them. So I'm looking forward to the results. You said early 2015?
I think early 2015. We were hoping maybe sometime this year, but I believe that first quarter next year. I'm cautiously optimistic that's when we'll be able to release it.
Great stuff. All right, so listeners, just to recap here, this is indeed the covered strangle strategy that we're talking about. It just involves essentially owning the underlying, selling a covered call, and also selling what amounts to a naked short put on the downside. That term may scare you, but at the end of the day, the risk is exactly what we just talked about. And if you're looking for ways to increase the income on your portfolio and you're okay with the risks we've outlined here, then this strategy is certainly one you should consider. And now, because we don't get to do this show very often, I want to make sure you guys get some time to shine on the program. You send in such great questions. We're going to roll on into the listener mail segment of the show for a great listener mail palooza for as many questions as we can squeeze in here for the rest of the show.
Listener mail. Listeners write in. Mailbox.
All right, everybody. Welcome to the listener mail segment. As the name implies, this is the portion of the show where you guys get your chance to join us here on the Old Advisors Option panel. Make your questions and comments known not only to us, but to your fellow listeners out there, your fellow advisors, and indeed advisor clients out there. No shortage of ways for you guys to get a hold of us on the old program. You can, of course, find us on the website, theoptionsinsider.com. Leave us a comment on the show notes or shoot us a comment anywhere on the site. We'll find it, or use the website feedback form. 2 easy ways to do that. You can, of course, find us via email, questions@theoptionsinsider.com. Just be sure to put question for the advisor's option somewhere in there so we know where to route it. And also you can find us on social media, twitter.com/options, facebook.com/theoptionsinsider. Also, I always forget to mention, I should mention Stock Twits as well. We are the Options Insider on Stock Twits as well. So no shortage of ways for you guys to find us and make your questions and comments known. And if you want the easy way, again, it's all baked into the mobile app, so you can just do it that way as well. All right, kicking things off here, we have a question. This is a good one, actually. This comes from Neil Berg. He writes, question for the Advisors Option radio program. Well, you sent it to the right show, Neil, so congratulations. He goes on to write, love the show. You've discussed financial advisors using options for income generation and risk management on previous episodes. Is that the only acceptable use case for advisors and their clients? What about the speculative usage of options? Do you feel it's suitable for advisors to utilize options for that purpose? If so, which strategies would you recommend? An interesting question. Sometimes a bit of a loaded one. People get a little bit nervous whenever we talk advisors and options and speculation, but certainly that is a legitimate use case if you're aware of all the risks and all the benefits therein. It's certainly one we've talked about sometimes here on the show in the past. But before I go on, I'll let you guys dive in here. Maybe Randy, we'll start with you. What do you have to say for our friend here, Mr. Berg, who wants to know about more of the speculative uses of options?
Well, I think as long as it's in proportion to the portfolio that you're advising on, I think it's a fine strategy to use. And, part of our strategy in the defined risk strategy is we do use some speculative trades in terms of other income trades. But as I said earlier in past episodes, it's always in the right proportion, we think, to the underlying portfolio. So you don't want to use 20 or 30% of your portfolio allocated to the speculative portion of option strategies.
Mr. Kavanaugh, same question for you, sir. I'm sure you have a lot of clients coming in, and maybe some advisors you meet with as well, who ask a similar question like this. So what do you have to say here for our friend, Mr. Berg?
I think Randy's spot on. I mean, as long as you can afford to lose it, you understand what the risks are. I mean, speculation is fun. I always say, if you're going to be a pure speculator, just put in the market what you can afford to lose. I always thought it was a compliment when you had a peer speculator come to you as a broker, because the women in Vegas are a lot better looking than me, and the drinks are free, is what I tell everybody. That's just pure speculative. But it's fun to take the speculative play from time to time. So as long as you understand the risks are disclosed, you're working with the professional. I don't have an issue with speculation as long as it's done the right way.
Mr. Eric, take us home, sir. You talk to a lot of advisors out there. What's your take on what they're using options for from a speculative perspective, as well as your own take on them using them for that sort of use case?
Yeah, I'm going to echo Randy and Michael's comments. I think it really does come back down to suitability. What we found, in the Bellamy study, that quant study that we released for the second time this year, interestingly so, Mark, the number of advisors who are using options and using it from a speculative nature actually dropped from 2013 back to 2011 when we first did this study. So I thought that was interesting, from the 2013 to 2014, that the percentage of advisors said they were using it for speculation actually fell. It's interesting that, retail clients, I jokingly say down here, all the retirees in Florida or whether in Arizona, find option strategies, and it's like the holy grail, and that predominantly what the retired people are doing is speculating in it, and they're only right until they're wrong, and then they get a hard lesson. But it just goes down to anything else. I mean, investing, you have to know the risk and rewards. And, there most certainly, Randy put it very well. Look, if there's a portion of it that you can allocate to it and you have the stomach to know that you could lose it, there's no reason why you can't integrate that into what you're doing as far as the strategy goes. But an advisor needs to be well aware that when they're working with their clients that they need to put this up front. And and it really comes down to, I think predominantly what advisors focus on when it comes to this type of investment is integrating a covered call. I mean, that tends to be what, as we all know, what they're using. But look, it's out there, it's available, and I think that advisors shouldn't be intimidated by it.
Yeah, we certainly tend to focus on this program on the risk mitigating side of options as well as the income side, because those are, quite frankly, the two most common use cases for the vast majority of advisors out there. They have clients coming to them with long equity, long index positions. They want to hedge them. They want to generate income, sometimes do both. So those are the strategies we focus on, but we've touched on many times on the show in the past different strategies you could use for this speculative side. And just because it's speculative doesn't mean you have to go 1,000 to 1 on the leverage or anything like that. All the strategies we've used and talked about here on the show in the past could also be defined as speculative depending on your outlook. Even what we just talked about right now, there's a speculative component to that. You have an underlying component. You're obviously speculating that the underlying is going to increase. That's why you're putting on that position. So all the strategies we've used here, obviously we tend to lean more towards the risk mitigated type of strategy, even when you're doing speculation. So not just going out and buying all of your dollars worth of out of the money calls and watching them decay to zero, but doing something a little bit more premium mitigated, a little bit more risk mitigated, like a vertical spread, instead of just buying those out of the money calls, or perhaps different strategies we talked about here, like iron condors, iron flies, butterflies, things like that you understand and get a lot of value out of and have a lot of use cases in a lot of different environments. Those are the types of strategies we recommend, as opposed to just going out and swinging for the fence. I think that's what a lot of people think of when they think of options and using them in a speculative sense. It's, I'm just going to load up and swing for the fences. And at the end of the day, that's not exactly, or really not at all, what we're talking about here. There are a lot of ways to be speculative with options and still in a very risk-defined way. And that's exactly the way we outline here on the show. So go cruise through those archives and see if you find a strategy that meets your criteria, that excites you. And if not, we have a bunch of other programs on the network that outline those types of strategies too, like Options Bootcamp, Options Playbook, Option Block as well. So a lot of different ways for you guys to find a lot of those strategies. Surf on the website. Go over to the OIC website. No shortage of ways for you guys to find those strategies and figure them out for yourself. All right, next up, we have a question from Spartan16, maybe he's a Michigander here. He writes, I've noticed that options tend to lose a substantial amount of value approaching long holiday weekends. He puts in parentheses, Thanksgiving, Labor Day, and others. Is this a known phenomenon in the markets, and is this something I can take advantage of as an income trader? Well, yes, it is a known phenomenon in the markets. It's been happening for some time. I hate to burst your bubble there, Mr. Spartan16. You're not the first person to stumble across this phenomenon. It does happen a lot. We just saw it playing out. We're recording this the week after Thanksgiving, listeners, and we saw it play out yet again last week going into the holiday week. It was, of course, a truncated holiday week from a trading perspective. So we saw people start taking that long holiday weekend out very early as even Monday of last week. So people don't wait around. When nothing is happening, they'll start taking that decay out at a very early period rather than wait until Friday afternoon before that long weekend to really take that decay out. So this is something that happens on a regular basis, something you need to be cognizant of if you're trading options. And if you're an income trader, you need to know that ahead of time, because if you're putting on your income trades thinking, I'm going to write this call on Friday afternoon going into a long 3-day weekend perhaps, you should realize that you probably already have missed the boat from a decay perspective. That option is probably already going to be trading at a value that is close to, if not approximately equal to, the value it's going to have on the open on Monday. So you're essentially giving away a whole weekend's worth of risk for very little reward, if any at all. There actually is a lot of school of thought these days that maybe that's a time to actually buy some options because you're getting essentially a free weekend out of it. So be cognizant of that if you are indeed an income trader. If you wait till the last minute, you're, of course, could have issues. Of course, there are times that doesn't happen either. You have issues maybe like on Friday morning there's a non-farm payroll number, something like that. That will keep that decay in there a little bit longer. So if you're comfortable writing those options before that event and taking that event risk, then you can capture some of that premium a little bit earlier in the week rather than having to worry about it dropping out on a Tuesday or a Wednesday of a long holiday weekend. But that is something that is a well-known phenomenon in the marketplace, and something that you'll have to deal with if you are indeed an income trader. Maybe, Randy, we'll start with you on this one. Anything you want to add to our friend here, Mr. Spartan16, who has recently stumbled across the phenomenon that options tend to decay a lot during holiday weeks?
Well, I think the assessment is correct. And I think the question is, when do you know, or can you know when it's actually going to be taken out? And so if we all actually knew, I guess we'd all be really rich. I think it's one of those things that you have to plan for and not be naive in terms of thinking you're getting something for nothing. I think once you do that, I think it's kind of a non-event, I guess, as I would argue.
Yeah, that's always kind of where the dice roll comes in, is when are they going to take out that weekend? When are they going to start hitting it? And if there are events later in the week, or if there are macro concerns, it's probably going to come out later in the week, Thursday into Friday. If there aren't those events, like we saw last week, there weren't any events on the calendar later in the week. There really were no major macro concerns. They started taking it out very early on Monday even. So it really depends on the week and the environment. But that is the big question. When will they start taking that weekend out? And if you can figure that out, like Randy said, you will be a very, very rich fellow. Mr. Kavanaugh, Mr. Eric, anything to add here for our friend, Mr. Spartan16?
I was just going to add in that it's typical a Michigan Spartan would ask a ridiculous question like that. See, a Badger like myself or Michael Kavanaugh wouldn't ask a question like that, because if anybody paid attention to what happened over the weekend, we did get the Paul Bunyan axe back. We are going to beat Ohio State this Saturday, and I'd like that Spartan to go back and figure out what happened at Ohio State, and maybe he would ask better questions about volatility and what happens during holidays with options. Right, Michael?
Yeah, I mean, that's one way to look at it. I'm sure the half of the listenership from Michigan just turned off the radio. But, yeah, I mean, nothing to add. I mean, you guys covered it perfectly. I mean, the guys that are on the other side of the trades that we're taking on, the market makers, they're some of the smartest, quickest, fastest, whatever you want to call it, risk-minded traders in the world, and you're really not going to sneak anything by them. You know, the phenomenon that exists, like volatility, impacts options pricing, and so does the time decay. The impact of volatility is higher than time decay, so you might see it wind down closer, like on a 3-day weekend, but the impact of volatility is by far more impactful on an option. And like Mark said earlier, if you want to take the risk of what appears to be a phenomenon that truly isn't, just be aware that the gamma the gamma and the volatility in an option can far outweigh just what appears to be a couple of free days of theta.
Yes, that's true. A lot of people tend to overlook. They focus on one Greek and they forget the other few out there. They focus on theta, they forget about gamma, or they forget about vega, or the intertwining of all of them. So interesting stuff. Everyone forgets about rho, but then again, no one really needs to know about rho right now. There's no interest rates out there. All right, next up, we have a question from Mr. Alan B., writing out of warm, at least warmer than here, Baton Rouge, Louisiana. He writes, my question is for the Advisors Option Radio. Well, yet again, you've put it in the right place, so congratulations. He goes on, first, love the network. You fill my commute with knowledge. Well, thank you for that, Mr. Allen. Flattery will get you everywhere here on the program. He goes on, second, I've just discovered Advisors Option and have been listening to the archived episodes. In an early episode, the RCM representative, sorry, don't remember the name, mentioned a triple income strategy. I understand the two income components of selling the put and selling the call. What is the third income component to this strategy? Thank you again for so much great free education. Well, Mr. Mike Kavanaugh, clearly that was you. Clearly you made an impression, although not enough for them to remember your name.
Right. So I am the no-named advisor representative of RCM.
What do you have to say for our friend here from Baton Rouge?
All right, Alan. The third income stream is when you're assigned the put. If you're assigned the put, is the dividend the stock pays. That's the third income stream. So you're going to get less put premium and less call premium on a dividend-paying stock. The higher the dividend is, the less volatility there tends to be in the stock. The less volatility there tends to be in a stock, the less premium you collect on the options. So it's all, if you're in a growth stock that doesn't pay a dividend, then it is not the triple income strategy. You won't get the dividend from it. It is just the dual income strategy in that capacity. But we look for the more value stocks that pay a dividend when we are doing the triple income strategy. So that is the third leg of the strategy, so to speak.
I know we just touched on it at the top of the show, but go ahead and give our listeners a quick refresher on what he's talking about in case they're not familiar with that.
Some people call it the wheel of fun, triple income. I mean, basically, we look at some stocks, like I said, that pay a dividend, and you start, with cash in your account, and you sell a put. If the put expires worthless, you get the income stream that comes from that, from the expired premium. And then you just do it again next month until you are assigned. And then when you are assigned, you still keep that original premium, and then you sell a call, and then that creates an income stream there as well, and then you'll be getting the dividend on the stock. And you just keep selling that call until you get called away, and then you start over. You just continue it. That's why we call it the wheel of fun. It just goes into infinity that you're selling a put, getting assigned the stock, or not getting assigned the stock, and when you are assigned, you sell the call, and wash, rinse, repeat. It's a good way to take a little volatility out of your return. It's a little bit more exciting when you're doing it in a qualified retirement account of any capacity because it's tax efficient. You're not paying any taxes on the gains, on the options, or on the dividends on the stock. And if you get really lucky, sometimes you can get a little upside from when you sell the put and the stock goes up from where you may get assigned on the call. There's always an equal opportunity to lose money, but there is that potential upside as well. So that's the strategy. Alan, thanks for the question. I hope next time you remember my name. It's Mike.
There we go. Deeply offended, but happy to help nonetheless.
Not offended. Just want to make sure I leave a better impression this time.
But you're right. It is a good strategy for a lot of people. We said this many times on this show. If you're comfortable out there working limit buy and sell orders in equities, and I'm assuming most people listening to this show are, then you should be getting paid to do that. And that's kind of what that Wheel of Fun takes that concept to the next level. You're not just doing one of them. You're doing several of them in a sequence. You're getting paid to get in. You're getting paid to get out. And hopefully, as you guys have done it up with the dividend side, maybe you get paid a little bit extra while you hold the underlying as well. So there you go. 3 incomes for the price of 1. All right. And next up, we have a mega question here from Michael Roberts. He writes, I came across your program while looking for new diversification options for my clients. Hopefully he didn't put pun intended, but I'll put it in there for him. He goes on to write, I find your suggestions about collars and protective puts very interesting. I've also been reading new research about volatility itself being positioned as an alternative asset class. This leads me to 2 questions. 1, do you agree that volatility is an asset class? And 2, what is the best process to gain exposure to that asset class for my clients? Is simply buying an option with a substantial Vega component sufficient, or must I purchase a dedicated volatility asset such as VIX options or an ETF like VXX? Well, this is a great question, a very loaded, very contentious question for a lot of people in the space these days, because that is a hot topic of volatility as an asset class. As you might imagine, some venues out there like the SIBO and others who have substantial skin in that game have been beating that drum for some time, that volatility is indeed an asset class. And certainly in recent years, when we saw a lot of correlation across a broad variety of different asset types, like the metals and like fixed income and like the equity markets all kind of moving in lockstep, there certainly was an argument to be made that, hey, this is the one asset out there, quote unquote, that is moving with any sort of inverse correlation to the underlying markets. And so therefore it's worthy of consideration for that reason alone. So there's a lot of different reasons why someone may be looking at volatility and thinking of it, deeming it as an asset class. And maybe before I dive in anymore, I'll open it up to you guys, let you guys dive in a little bit. Perhaps, Randy, we'll start with you. You obviously spent a lot of time looking at volatility and analyzing it for the various overlays you guys are constructing, as well as the mutual fund and the other products. What do you have to say here for our friend, Mr. Roberts? First off, let's start with the number 1 question. Do you agree that volatility is an asset class? And then we'll go on from there with number 2 about the best ways to actually implement it.
I guess I would start off by saying, traditionally it hasn't been an asset class. I know I get the arguments of why maybe it should be, to have some inverse relationships of assets that may go up when everything else is going down. But I guess I look at it more of a component of an option is more important. And I think the bigger question always is, can you really profit? I think we've done shows on this in the past. The difficulty, I believe it is, using these options to over the long haul actually make money or diversify your portfolio in a way that you feel like there's substantial benefit over long periods of time. I guess that's the way I would tackle it from is, it's really not as important that you need, whether it's an asset class or not, is should you use it in your portfolio? And the direct approach would be, buying the assets that he mentioned, the direct VIX or a product like VXX. I always go back to, will that actually improve your portfolio over time? If it can, then obviously I think it's a viable component of your portfolio. If it's not, I think it may be something turns out to be a drag on your portfolio and not really work the way you want it to. In an example where maybe the market drops substantially but volatility doesn't go up, then you may not get the benefit you want.
The one element he doesn't mention here as well is, and that's another issue a lot of people encounter when they start trying to add volatility to their portfolio, they buy that downside put. Could be SPX, could be some other product, and that gives them a volatility component as well. And they start realizing all the issues that people who do that on a regular basis start to encounter in terms of those are very expensive and other issues, and trying to make that profitable for their clients in the long run. And they start getting into some of the elements that you guys have done over there at Swan, Randy, where they start adding other elements like the covered call element, like the put spread kicker to the downside, if you will, as ways to finance that volatility. So it becomes a very, very involved process. But that's something you guys have spent a lot of time working on, trying to find ways to add that volatility component and also finance it at the same time, which is a very, very difficult challenge.
Absolutely. It's a big component of what we do. We've benefited during markets that have gone down by having that exposure to the put options. But from my perspective, a strategy that's really going to work over long periods of time, has to be cost effective. And I think that's where we get back to whether or not you can do it with the products he mentioned.
Yeah, those products that he mentioned, that's kind of the people's first foray into volatility a lot. They say, I'm getting into volatility. I should trade one of these dedicated volatility products. I think we've had some shows here in the past, certainly other episodes on our network, getting into some of these dedicated volatility products. I'll have to check our archives here. We've done so many now. I know we've done shows on volatility. I'll have to see if we've touched on the actual VXX and other ETPs as well. Maybe I'll do that while Mr. Eric, you're chiming in here. I'm sure you crisscross the country talking to a lot of advisors, going to a lot of conferences. I'm sure this question has been broached to you in the past. Is volatility an asset class? So what do you say to that first, and then talk about some ways you're seeing people implementing to get volatility into their portfolios in a responsible way?
Yeah, I'd agree with Randy, Mark, and I think one of the issues with advisors is that they're bombarded with information, and they haven't even gotten a handle on VIX in terms of how they need to incorporate just the general discussion of it, that they see it, their clients see it, and obviously the lack of volatility that we've seen other than the brief period we had in October. Look, many of the asset managers that are out there are trying to create sort of new and sexy, packaged products that will incorporate vol as an asset class. We've seen a flow of assets from advisors going to structured products, which are claiming to have this volatility component in it with a very expensive cost. We've talked about this on prior shows, Mark. I think that, it's the bottom line comes down to the concern that clients have with, the gyrations in the market and which direction we're heading. And clearly, advisors have looked at adding, protective puts on the downside for their clients. As far as trading in the futures area, which I don't really, kind of focus on that much. I know Mike can add a little bit to that. Obviously, with the XX and other products that are being introduced to the market, there's a place for it. I think that the bottom line is, that I think it's more over the last couple of years that, some of the big mutual fund and ETF providers have, and even some of the annuity companies have incorporated this terminology of volatility in there. And I wouldn't say they're misrepresenting it, but really, what is the ultimate outcome that the advisor along with their client is looking for? And is it that they're concerned about a black swan event, if something precipitous going to happen? How are they reacting to that in terms of the overall portfolio? And is there something out there that they feel is going to provide them with, I guess, the solution? Yeah, Mike, I don't know if you want to add,
Yeah, I think both you and Randy made great points. I don't think volatility as a standalone is an asset class. I mean, any more than a bowl full of chocolate pudding is an asset class. It just doesn't make sense as a standalone asset class. There's no value in it. It's not brick and mortar. It's not a bond. It's not a stock. It's not an asset. Now, I will say it's a very useful tool in protecting asset classes. But I think the nomenclature, whoever's out there pumping the research on volatility as an asset class, they should call it what it is, which is a hedge. If you have a certain amount of your portfolio, and there's good studies out there that date back to, prior to the credit crisis. And if you have a certain amount of long VIX calls in your portfolio, or, if you finance those VIX calls by selling VIX puts, and there's an explosion in volatility, it does a good job of hedging an equity portfolio. I would call it an equity hedge. Anybody that tries pitching volatility as an asset class, as a pure asset class, I don't really totally agree with it. I'm not saying they're wrong as much as call it what it is, and it's a hedge to, your portfolio for, the times when the market does get volatile.
Well done from our token RCM representative, sir.
That's right.
I forget your name.
The RCM representative.
But you're right. I saw a lot of that talk really emerging a few years back when the correlation was really high. People were really starting to beat the drum very aggressively for that volatility as an asset class type argument. It's kind of diminished somewhat as of late, as underlyings are starting to exhibit their own independent movement again, and so the need for an alternative asset class is a little bit less. But still, volatility has a huge value, regardless of whether you see it as a distinct underlying asset or just, like you guys said, a tool for your portfolio. Either way, it's certainly something you should use. Mr. Roberts here, if you want more information about volatility and indeed the VIX ETPs you mentioned, like VXX and others, I encourage you to check out episode 20. We did that in June of this year. We took a deep dive into volatility and kind of all things VIX on that episode, explored a lot of the volatility ETPs. I just caution you, if you're going to use that route to get into these, that really do a thorough investigation of what these products really are. A lot of people come in and they think they're buying something like a VXX and they're getting a VIX surrogate, and it's not really the same beast. They perform differently. There's a lot of issues like roll yield that compound the difficulty of making a really substantial gain. A lot of people will come to VXX and buy it and use it as their kind of long-term proxy for VIX and think, VIX cash is trading around a 12 right now. I think the long-term average is somewhere around 18 or 20. I'm going to buy this VXX and put it in my pocket for 6 months, and hopefully VIX is going to spike over that time frame. That's pretty much the worst thing you could do, because that product gets crushed every month by roll yield and real balancing. So investigate these products before you do that. Maybe you want to look into more of the options on the VIX, or indeed the VIX futures, if you're more savvy on that end, to really get a little bit more direct approach. Or speaking of direct, nothing wrong with a good old S&P put at the end of the day, as long as you understand ways that I just talked about with Randy that you have to go to actually mitigate the cost of doing that, because those get pretty expensive pretty quickly. But either way, we definitely on this show, I think, tend to prefer the more direct approach of using the options and the Vega component of the options as your volatility exposure, rather than going to a quote-unquote pure volatility product that really probably will perform below your expectations. So bear that in mind, Mr. Roberts, and hopefully good luck as you go out there with your clients. And again, check out episode 20 if you want to learn more about those topics. And unfortunately, that's all the time we have for the listener mail segment on this episode. Great questions. I love what you guys send in to us. Keep them coming. That's also all the time we have for this episode of the Advisor's Option. But before we go, as always, I want to check in with each of my cohorts here on the old Advisor's Option panel to see what they have cooking that may interest you. And starting off, we'll go back in that same order from farthest to closest again. We'll start off with you, Randy. What's coming on the pike in the land of Swan, in addition to all that warm, tropical Puerto Rican weather that our listeners can look forward to?
Lots of change going on at Swan. We changed our name, actually. I forgot to tell you this, to Swan Global Investments, to take into account the operations that we're doing outside the U.S. We have a new website that's been launched over the last month, and we're launching a new emerging markets version of the defined risk strategy that we're launching hopefully in about a week to 2 weeks, a mutual fund, so 40 Act fund. So we're pretty excited about that. It's based on the same value proposition that we think we can lower risk and provide generous returns on almost any asset as long as there's liquidity in the options market. And so we're pretty excited about doing that. I think that Eric can touch into some of the studies that the OIC has done that have done studies on other assets besides the U.S. markets and other various commodities and markets around the world. So we're pretty excited about that.
Well, that is actually big news. And here I am plugging Swan Wealth Advisors all episode. I had no idea that you have rebranded completely over there. But I'm looking at it now. It looks pretty cool. Listeners, in the past, I've sent you to swanwealthadvisors.com. You can do that now, of course, but it'll redirect to swanglobalinvestments.com. Very cool castle on the homepage there, and all that same content is still there, the defined risk strategy and all the other stuff, as well as some interesting new stuff there as well. So congratulations there on the rebranding there, Randy, and we'll be sure to discuss it more on some future episode.
Thanks.
All right, and Eric, Mr. Swan there mentioned you guys, all the studies. Of course, you touched on them earlier as well. You guys always have a legion of studies. I like bringing you guys on the show because you guys really bring the data. So what's coming down the pike? You mentioned those studies in early 2015. Anything else you guys are cooking up over there at OIC that may interest our listeners?
Yeah, absolutely, Marcus. First off, congratulations, Randy. That's wonderful. I think it does. It's indicative of the expansion that you guys have had in such a short period of time and the global nature. I should mention, Randy, full disclosure, Randy and Michael are both on the OIC Sub-Advisory Leadership Council, which is exciting that both of those gentlemen participated. We've had a group of some really successful leading RIAs and advisors in the industry who have given us feedback, and we will be hosting this group the first week of May at the Fontainebleau in Miami. Mark, as you know, that's going to be the OIC conference sponsored by all of the exchanges, but the lead exchange will be the BOX Exchange, the Boston Options Exchange. That will be taking place the early part of May at the Fontainebleau. We've got a lot on our plate here at the OIC. The whole team there going into the first couple of months of next year with us. I'll be presenting at the TD Ameritrade Conference, and then also we'll be participating in the Barron's Top 1000 RIA Conference in March. That will be taking place in Arizona. And, Mark, I'll have the good fortune of seeing you in Chicago in a couple of weeks. We'll be having our annual OIC media party in Chicago, and I know you'll be there with all of our other colleagues. So I would say not only to everybody in this call and all the listeners, but more importantly to the Spartan who sent the question in. I'm wishing him a very happy holiday, and I hope his team does well in the next coming weeks.
There you go. We can all be friends at the end of the day, right, sir?
Absolutely.
All right. Lots of good stuff coming down the pike from the OIC as well. If you want to check that out, listeners, surf on over to optionseducation.org to learn more. They have a financial advisor tab there you may want to check out. Lots of cool stuff. All those studies I've talked about, all available there for the simple act of logging in over there at optionseducation.org. All right. And take us home, Mr. Unnamed RCM representative. What's coming down the pike in the land of RCM?
Yeah, we've got a lot coming out down the pike. We've got, as I mentioned earlier, we're going to be just wrapping up our first full calendar year on our RCM North America tour. So we're going to be ending in Miami next week. We'll be in Miami to talk about manage futures to registered investment advisors. So we've got a couple of partners, the Chicago Mercantile Exchange, KCG Futures, and Millennium Trust that have and McLadry that have been traveling around with us on our traveling dog and pony show across the United States in the last 12 months. And this wraps up this calendar year. We've got some great CTAs that come and some great service providers. Like I mentioned, McLadry on the accountant and auditing side. We also have some great partners in the future space, Millennium Trust and whatnot. And really just meeting a lot of people and talking about how managed futures play a role in the advisor's, client-advisor relationship as far as how to allocate money to the alternative space. And we just meet a bunch of great people in the registered investment advisory world. And if nothing else, we do have a cocktail hour after our educational events. So come on out. If you're in Miami, you can shoot me an email. It's theunknownadvisor@rcm.com. No, just kidding. It's mkavanaugh@rcmfs.com. I'd be happy to shoot you an email with the details of the event in Miami next week. And then we're in Phoenix in February to kick off year 2 of the North America RCM Alternative Investment Part 2 tour. So Miami in December, Phoenix in February.
All right, and check out that RCM World Tour coming to a city near you. And on behalf of Randy and Eric, and indeed our unnamed RCM representative, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming. We love to hear from you guys. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.